Welcome to the Explainer. Today, we're diving deep into an intermediate trend-following strategy, one that's designed to give you a way more nuanced read on market momentum. This is all about moving past simple signals and really understanding the strength of a trend.
So think about this for a second. A lot of simple strategies, they hinge on just one single event, right? Like one line crossing another. But that's pretty binary. It's just an on or off switch. It tells you if a trend might be starting, but it doesn't tell you how strong it is. So what if you could do more? What if you could actually see the strength of a trend in real time?
And this, right here, is the core upgrade we're talking about today. Over on the left, you've got your basic crossover, a simple yes or no. But on the right, you have the ribbon. Think of it less like a switch and more like a gauge on your car's dashboard, giving you a continuous read on the trend's strength. We're also shifting from a slower daily chart to a much more responsive hourly one. So this isn't just a new tool, it's a totally different way of seeing the market.
Okay, so how does this dashboard for trend strength actually work? Well, it's built using 4 specific exponential moving averages, or EMAs. Now, the key thing you need to know about EMAs is that they give more weight to recent price action, which makes them way more responsive than simple moving averages. And that speed is exactly what we need for this strategy.
Here are our 4 key players. The 8 EMA is like our scout. It's the fastest and sticks closest to the price. The 13 is right behind it, confirming if that initial move has some legs. The 21 acts as our medium-term guidepost. And then you've got the 55. That's the bedrock, our major trend anchor. And yeah, it's probably no coincidence that these are all Fibonacci numbers. It's the way they line up or don't that gives us our signal.
Now, here's where it gets really interesting. We don't just eyeball this alignment. We actually measure it, and we use a concept called the fan score. It's a really simple but powerful system that just counts how many of our 4 EMAs are stacked in the perfect order, from fastest to slowest. This gives us a score from 0 to 4.
So, a score of 4? That's a perfect fan, a beautiful textbook trend. A score of 0 or 1 means the market is just a tangled mess. That's a clear stay-away zone for us. But here's the key, the real secret sauce. You don't have to wait for a perfect score of 4. A strong fan with a score of 3 is our green light to start looking for an entry. This is how the strategy aims to get you into a move before it's totally obvious to everyone else.
Okay, let's get into the playbook. This is where we turn the theory into exact mechanical rules for getting into and out of a trade. This is where it all comes together. For a long entry, the process is super methodical. First, you confirm you've got a fan score of at least 3. Then, and this is crucial, you wait. You don't chase the price. You let it pull back down to the ribbon, specifically into that sweet spot between the 13 and 21 EMAs. You watch for the price to find support and bounce. And your entry trigger? It's the candle that closes back above the fast 8 EMA. That's your signal that momentum is back on your side. You know, getting in is only half the battle. Knowing when to get out is just as important. With this strategy, you have 3 crystal clear exit signals. The main one is ribbon compression. When you see those EMAs start to squeeze together, it's a sign the trend's momentum is dying. A more specific trigger is seeing that fast EMA cross back below the medium-term 21. Or, the simplest one, you just get out when you hit your profit target, which is often set based on the market's recent volatility. Okay, but does this whole systematic approach actually hold up over time? I mean, a playbook sounds great, but it's only as good as its results. So let's put it to the test and look at the performance from a massive 15-year backtest.
The big headline number here is the Sharpe Ratio, which clocked in at 1.1. Now, to put that in perspective, professional quants generally consider any Sharpe Ratio above 1.0 to be really good. It basically means you're getting strong, consistent returns for the amount of risk you're taking on.
And when you dig into the numbers, you can really see the statistical edge this thing has. A 62% win rate is pretty solid, right? But the real power is in the risk to reward. On average, the winning trades made 2.3 times more than the losing trades lost. And it did all this while keeping the maximum drawdown to just 15%, which, by the way, is the lowest of any of the strategies we've looked at so far.
When you put it side by side with some of those simpler crossover strategies, the difference is just, well, it's clear. The EMA Ribbon's ability to read trend strength, not just its existence, gives it a serious, quantifiable edge over that 15-year period.
But of course, let's be real. No strategy works in every single market condition. So the real skill here is knowing when to use this tool, and maybe more importantly, when to keep it on the shelf.
Let's break down the ideal environment for the EMA Ribbon.
This strategy absolutely sings in markets that have a clear, sustained direction. We're talking major forex pairs, crypto, and stock indices when they're in a strong trend. It's kryptonite, a choppy, sideways market. In those conditions, the ribbon is just going to get tangled and untangled over and over, and you'll get chopped up by a bunch of small losses. A simple fix is to use a volatility filter, like the ATR. The rule is simple. Only take trades when the current volatility is above its long-term average. It helps make sure there's enough gas in the tank for a real trend to get going.
You know, this quote just nails it. It really sums up the entire concept perfectly. It's about graduating from a simple binary question to a much more detailed, dynamic answer. It's truly the difference between seeing the market in black and white versus seeing it in full color.
So we've walked through the mechanics, the specific rules, and we've looked at the long-term data. You've seen how reading trend strength can offer a completely different perspective than a simple crossover. The question I'll leave you with is this: how can you use this core idea, measuring trend strength, not just its direction, in your own approach to the markets?